Hello, everybody. It's me again, and I just want to make a couple points about some important stuff in Chapter 2. And I'm on slide I guess about slide 4 here, and basically I just want to make a point about funds from external sources, meaning outside, and they can come from a financial institution such as a bank, right? Everyone should know. When they say financial markets, that would be what? The bond and equity markets. And private placements would be from private investors, right? Such as angel investors or venture capitalists or even your own family. So that's what that means. And an intermediary is someone who's in between. So if you need a student loan or a car loan or a mortgage, and basically the bank would kind of be an intermediary, right? And basically these institutions are intermediaries that channel the savings of individuals into loans or investments. All right, so there's two types of banks, and they've been brought back together by repeal of the Glass-Steagall Act. So commercial banks that where companies can invest their funds or offer loans. And investment banks are banks that help companies go public, such as with an initial public offering of stocks and bonds. And institutions were all one at one time. These were combined. Glass-Steagall years ago broke them up, but now they've been put back together again by the repeal of the Glass-Steagall Act. And here's where I talk about, here's the Glass-Steagall, and it separated the activities of the commercial and investment banks, and basically that's been repealed. All right, so financial markets, so everyone knows, are suppliers and demanders of funds, trade, and there's sometimes some financial markets are called money markets and capital markets. And you'll notice here, this is an important line here. Transactions in short-term marketable securities take place in the money market. That is short-term. So I just want to highlight, this is money market, less than a year, right? Short-term. Okay, private placement is investor or groups who have private money. And public is when we all trade with each other on stock markets, right? So I want to just make that point. All right, so the primary market is when an IPO is issued. Companies through an investment bank will issue new stock, okay? So the primary market is the financial market, and the important word, initially issued, right, through an IPO. And then the secondary market is you and I, when we trade amongst each other for securities, right, online, on Scottrade, and we buy and sell from each other. Okay, I just want to make sure everyone's clear about that. And let's move on. And this is a graph that simply shows how money flows around. All right, so the money market is for short term, as I said, and let me just highlight that here. The money market is created by a financial relationship between suppliers and demanders of short-term funds, right? And these are called marketable securities, and they're short-term, as I said right there. And that includes U.S. Treasury bills, which pay very low interest, and those are called government securities. And commercial paper is when money is loaned by businesses to each other. And a CD is a negotiable CD is what you'll buy in the bank. Everyone must buy a CD once in their life, right, in the bank. And these are pretty safe securities, and they don't have much to worry about. All right, so the capital market is the buying and selling of stocks and bonds, right? So everyone should know that, right? So you buy and sell to each other, and here we have bonds that are long-term debt. And we have common stock, right, that we all know about from companies like Apple and IBM, and then there's preferred stock. Okay, so preferred stock gets its dividend first because they are preferred, right? Okay, so here's a good example about bonds. So I'm going to spend a little time on this slide. A 9% coupon interest rate, 20-year bond, and the $1,000 par value. This is redundant. When you normally see the word par, it does mean $1,000. Okay, trading at par. So this tends to be redundant. And paying interest semi-annually means you're going to get the coupons in the mail every 6 months. So how much coupon are you going to get? If it pays 9% per year, 9% of 1,000 is $90, as you can see here. But because it pays it every 6 months, you're going to get $45 every 6 months. If anybody's not clear about that, let me know. And when the bond matures at the end of 20 years, you're going to get your money back. You're going to get your $1,000 back. You're just letting them borrow it, okay? And they're going to give you coupons or interest for letting you borrow their money. All right, so that's basically it on that slide, but that's important. And broker markets mean markets like on the New York Stock Exchange that we see on CNBC, the New York Stock Exchange on Wall Street. There's a trading floor, and you see them running around and papers flying everywhere. And that's different from dealer markets. Dealer markets are computer traded markets that there's no trading floor, and there's like NASDAQ, right? And everything's done via computers. So you'll notice here it has no centralized trading floors, and they're linked together. Here's the important stuff: via mass telecommunication networks, and that's called NASDAQ. Okay, and what NASDAQ means is National Association of Security Dealers Automated Quotations. Okay, so how do the market makers make money? And there's an important term called the spread, the bid price, ask price. When you buy stock, there's always two prices: the prices the market maker is going to buy it from you at, and the price the market maker is going to sell it to you at. Okay. So that's where the spread is, and they always make money on the buy and sell orders. Okay, so just jumping ahead a little bit. Capital markets, you have to have an efficient market. An efficient market simply means, right, all the information that's available technically is out there, right, and it allocates funds of competition among wealth maximizing investors, and all the information and the prices are publicized, right, and as close to their true value as possible. In other words, no cheating. Right? All the information that is available supposed to be out there, but that's not truly how the world works. All right. And behavioral finance is an important field where people study the psychology of finance and trading and how people act with regards to markets. Right? Most people heard if their friends buy a stock, well then they'll buy a stock, and people will follow the crowd, so to speak. So there's that whole behavioral approach. Into a finance and the psychology of stock trading. All right, so I'm going to move on to some stuff, and here's the house prices, and here's the crash of 2008. Maybe some of you were too young, but you'll notice this big crash after 2008. You were probably 8 or 9 years old back then, but it's a famous crash that occurred. And here you see the bank stocks crashing during that same period. And here's the bank stocks plummeting. Again, here's the big, you can see everything coming down here. All right, so the Glass-Steagall Act, which I mentioned previously, right, separated investment banks from commercial banks. And you see it prohibited institutions that took deposits from engaging in activities such as security underwriters and trading. But it was repealed in, I believe, the year 2000. And now they basically they can come back. Those banks could come back together again. So you can see the Gramm-Leach-Bliley Act here. allows business combinations, commercial banks, and investment banks, and they could come together again. All right. So also you probably heard about the Dodd-Frank Act after the 2008 crash. All right. So taxes are important. This table is important, and the way you if you have any questions on this table, please email me. The way you read this table is if there's a taxable income in this range, you're going to pay $22,250 in taxes plus 39%, which is your marginal rate over the amount over $100,000. So again, if you have any questions, please email me about this table. It's important you know this table. And here's some good examples about how this table works. You should clearly go over this slide 25. 35 here. It's important. And again, slide 36 defines the marginal tax rate, and it defines the average tax rate. Okay, so what the differences are. So you should go over that. And again, go over these slides carefully. And if you have any questions, this slide is important too. This slide makes a point about companies that like to issue debt. And the important point here is that companies that like to issue debt do so because the interest that they pay, the debt holders, the bond holders, they can write off on their income statement. So let me show you an example here. Here's a company that issues debt. Everyone see that? And here's one that doesn't. Here's the interest they pay. You notice they pay $30,000 in interest on the bonds, whereas this company didn't issue any, so they pay no interest. But you notice how they're writing it off here. They're subtracting it. And look at the taxes. You notice they pay less taxes than no debt, $68,000 versus $80,000. They save like $12,000 in taxes there. So that's another important concept, real important. Okay. So all right. So what's a capital gain? Again, this is important. A capital gain is when a stock goes up, or a security or asset goes up in price. If I buy Google at $500 a share and it goes up to $600 a share, I have a capital gain of $100. Okay, you're only taxed on that $100 when you sell the stock. So please make sure you understand this concept here. And once again, email me if there's any questions. Okay, you must know what a capital gain is. And there's a good example here discussing a capital gain. All right, so that's about it for now. And that's it for Chapter 2. And I'll go over some stuff for Chapter 3, more and 4 in a day or so. All right, have a good evening, everybody.